We are witnessing an absolute heavyweight clash over the future of your digital finances. Welcome to This Explainer. Today, we're unpacking a massive battle between the centuries-old traditional banking system and a rapidly rising high-tech challenger, the stablecoin.
Think about it. Money is aggressively migrating right now. It's moving from physical cash and legacy bank accounts directly into native digital networks. Now, for well over a century, traditional banks have essentially held an absolute monopoly on this movement. But a nimble, highly efficient challenger has stepped into the ring, and it is disrupting that very foundation.
Which brings us to the core question of this entire explainer. Will stablecoins actually become the undisputed next generation of digital money, or will traditional banks adapt and choke out the competition? We're going to explore this matchup neutrally, relying purely on the facts so we can figure out exactly how you'll be storing, sending, and spending your money in the near future.
Here is how we're going to break it all down today. 1. Meet the new digital money. 2. Why stablecoins are growing fast. 3. The threat to traditional banks. 4. Risks and regulatory roadblocks. And 5. The 3 possible futures.
Let's jump right in with Section 1. Meet the new digital money. The defining mechanic of this challenger is just absolute simplicity. It's a one-to-one peg. The most common stablecoins out there are tethered directly to fiat currency. So the issuing company designs the token so that one digital unit equals exactly $1. This totally shields it from the wild, unpredictable volatility of the broader crypto market.
Because they maintain this stable value by holding actual, real-world reserves, they function entirely differently from traditional crypto. I mean, these are not speculative assets you buy hoping to get rich overnight, right? They are highly predictable utility tools. They're designed for actual spending and storing value, not gambling.
And this really exposes the extreme friction of the old system compared to the direct efficiency of the blockchain. Just think about traditional banking for a second. A transaction bounces from you to a bank, through a centralized payment clearinghouse, over to another bank, and finally reaches the receiver. It's clunky. A stablecoin, it travels directly from your wallet, through the network, straight to the receiver. Instantaneous settlement. But let's clear something up right off the bat, because it's vital to separate this from the headline-grabbing chaos of Bitcoin. Bitcoin's price fluctuates wildly based on market demand and scarcity. A stablecoin strips all that volatility away completely. Its one and only purpose is steady, reliable value transfer at a massive scale.
Which leads us perfectly into Section 2, why stablecoins are growing fast.
There are 4 massive, game-changing advantages driving this adoption. We're talking faster international payments, way lower transaction costs, easy global access to US dollars, and 24/7 availability. Picture an international worker trying to send money home to their family on a Sunday. Traditional banks are closed and wire transfers take days. Stablecoins make this instant and cheap. They completely bypass restrictive banking hours and those really expensive middlemen.
Because of those crazy efficiencies, the total stablecoin market hasn't just grown, it has absolutely exploded. We went from a few billion to hundreds of billions of dollars. Driven by heavyweights like Tether, USD Coin, and PayPal USD, this is clearly not just some internet fad anymore. The sheer volume of capital flowing here has actually forced the Federal Reserve to pay very close attention to how money is moving completely outside their walls.
All right, Section 3, the threat to traditional banks.
So, why are the legacy banks actually sweating? Because this challenger offers unprecedented speed and borderless access. Think about it. Near instant settlement versus hours or even days for cross-border wires. It's 24/7 availability versus strict 9 to 5 banking hours. And getting global access? All you need is an internet connection. No formal, heavily vetted bank account required. This all builds up into a true existential threat for banks, basically fighting a 3-front war. First, you've got deposit competition. If millions of people move their cash into digital wallets, banks literally lose their primary funding source for giving out loans. Second, payment competition. This threatens billions of dollars in revenue from wire and credit card fees. And third, big tech entry. Imagine massive tech and social platforms with billions of users bypassing banks entirely to just control the financial infrastructure themselves.
But it's not a done deal yet. Section 4, risks and regulatory roadblocks.
Look, this is absolutely not a one-sided fight.
The challenger has some massive vulnerabilities, primarily around trust and reserve risk. If users ever doubt that a stablecoin company actually holds the real-world dollars backing their tokens, that panic could trigger an instantaneous digital bank run. Toss in concerns about broad financial stability, a severe lack of consumer protections, and the risk of fast cross-border money laundering, and it becomes pretty obvious why global governments are stepping in as referees.
The acceleration we're seeing here is just staggering. We went from niche tech experiments, like Tether launching in 2014 and USDC in 2018, to explosive, widespread usage by 2021. But following some major crypto market failures in 2022, regulators aggressively woke up. Now, as we head toward 2026, creating strict stablecoin frameworks is a top-tier priority for massive institutions in both the US and the European Union.
Which brings us to the final showdown, Section 5, the 3 possible futures.
First, we need a quick reality check. Moving money is not the same thing as creating credit. It's a total myth that stablecoins will just automatically eradicate banks. The reality is that traditional banks provide mortgages, they provide business loans, and complex financial services. Because they actually have the power to create credit, legacy banks still hold an incredibly unique, massive structural advantage.
So where's this all heading? Well, the source material lays out 3 distinct scenarios for our financial future. Scenario 1 is coexistence. Banks just adopt blockchain tech, and consumers use both seamlessly. Scenario 2 is where stablecoins capture the payments layer entirely. Digital tokens dominate commerce, pushing banks strictly into the background lending business. Or, Scenario 3, regulation steps in hard and slows adoption, keeping stablecoins as just a niche tech. Right now, coexistence is looking like the most likely outcome, as the massive legacy system adapts to absorb the new technology rather than being destroyed by it.
Ultimately, the research leaves us with one incredibly important takeaway. The winner will likely be whoever controls the next generation of payment infrastructure. So, as we wrap up, think about this. The ultimate question isn't really just stablecoins versus banks. The real question is, will your future digital wallet be controlled by a modernized traditional bank or by a massive tech company operating entirely outside the banking system? That, my friends, is a multi-trillion-dollar question, and the battle has only just begun.